hugely comprehensive that effort that we are making to address the talent issue. And we have also we've also deployed one of our senior most leaders out of her P&L role to manage this. Okay, so that is one. The second part of your question is, not just the junior and mid-level talent, but what are we doing with senior talent, right? So switching tracks into that, and as I shared with you in our past couple of calls, Sandeep, right? So we launched our strategy. We are strongly in the execution phase. We are continuing to strengthen the team, and that includes sales, that includes delivery, that includes client partners, that includes subject matter experts. And our objective is to build a formidable team. And we have thus far been quite successful. Very happy with the kind of people we have brought to bear. And of course, we are providing to them, industry competitive compensation, right? So that I think we are confident that we've provided them with industry standard compensation. Now, as we discussed a couple of calls back, Sandeep, in one of your questions in the prior earnings, is that look, comp is based off the basic comp, the variable pay, and the stock options, right? The RSUs, etc. This is what most companies have. This is what we have as well. And I'm confident that the program that we have in place is attractive, right? But then outside of all of this, what we have done as a firm in terms of how we have executed on our strategy, we are strongly executing, how we have strengthened the team, how we have relaunched our brand, and the kind of energy and enthusiasm that has launched in the industry, within the company, from top to bottom, gives us confidence that we will gradually get this attrition situation under control. And as we speak, I'm not terribly concerned about significant attrition at the senior most levels.
So Ajay, thanks for that elaborate answer. I have another follow-on, and I know, I have taken a lot of time from you, but I will still, request you to answer this question. See, I have this concern from last 2 to 3 quarters that, this is one of the best times for the industry in the H&M vertical, and we are having substantial presence in that vertical, and the demand for that vertical is, I think, through the roof and probably one of the highest in the whole industry. But we are not firing to our best in that segment. So what are the gaps there? I believe that with such kind of huge segment, probably we have 2, 3 very senior leaders desperately required to fill those gaps in that segment. Or you think that, it is more to do with supply side constraints? What is that? Because that is the segment which can, really change our whole story, because I'm 100% confident that high-tech and manufacturing is going to be the best performing sector for next few quarters, if not years, because of the mad race to, upgrade the products to smart products from future products. And across Europe and across the manufacturing hubs in the world, we are seeing huge demand for high-tech and manufacturing, but we are not able to, post that kind of number in that vertical. And even some of our peers have done much better than us, despite we being so strong in that vertical. So any thought on that side? Is it attrition-led challenge? Is it some slippage, or you think that, it will take some time to come back?
Yeah, no, Sandeep. So very pertinent question, right? I mean, see, first of all, let me back up. We have seen growth across all verticals, across all geographies, across all service lines, right? Number one. Number two is that for us, high-tech manufacturing is basically 3 different, sub-verticals. There is high-tech, there is manufacturing, and there is emerging, right? If you take high-tech plus manufacturing plus emerging, we have done quite well. Individually, there are parts of the portfolio which is up, down, left, right, agreed. But if you take this, which is high-tech plus manufacturing plus emerging together, then we have done quite well. And so that is one. Second thing is, you're absolutely right. High-tech is going to see continued growth. We see traction as well. we'll see a little bit of an up and down movement basically, based on projects starting, projects closing, etc. But overall, I think I'm feeling very, very good about what we are doing in high-tech manufacturing, as I'm feeling about our banking, financial services, insurance vertical, and as I'm feeling about our consumer services vertical. So that is what I can share, Sandeep, right? And then overall, look, the supply constraint is an industry-wide constraint, right? And we have a plan to address that. What we're doing is we're not taking any short-term measures. We're not taking any immediate reactions. We're taking a very, root cause, long-term view in terms of how we address this problem. And as we continue to address this problem, this will translate into even better business performance than we are delivering right now.
Well, let me reframe that question. So will you be in a better position if we are able to find 2-3 very strong leaders more to add below the head level? Will we be in a better situation than what we are today, or you think all strategic gaps within the high-tech manufacturing hub is already in place? That is what I want to know, because I think that it looks like from the numbers and when you dissect them that there is 1 or 2 leadership positions which are vacant, key positions which are vacant in that vertical. Is my reading correct, or you have already done you have already brought in people and it will just show up in next few quarter numbers? What is the way to look at it?
About this one. And you know what? We have the person on our call, Harjot Atri. So Harjot, do you want to take that question?
Yeah, thanks, Ajay. So, we have redesigned and launched a new high-tech and manufacturing vertical with a new strategy, a new set of offerings which are focused towards where the clients will spend for Enterprise 4.0. That strategy is getting validation at the ground level, by the recent new wins we have, both in existing customers as well as new logos as well. And we have a very healthy pipeline as well. Now, we also are continuously looking, you talked about the leadership team. So the new structure is also ready and the new leadership team is coming on board. So by Q3, we'll have, the complete leadership team on the board and very dedicated, focused on the new logo hunting as well. So there are all the pieces in terms of new strategy, offering, building in some very functional domains aligned to Enterprise 4.0 and leadership that all come together by end of Q3.
Yes, thanks. That's very helpful. That is what I was trying to, find out. Thank you. Thanks a lot. Yeah.
Yeah, you're welcome.
Thank you, sir. We have next question from the line of Mukul Garg from Motilal Oswal. Please go ahead.
Thank you. Ajay, just following up on Sandeep's question, there was some softness in your top 5 accounts this quarter. Now, if I combine that with the reduction in exposure, in the high-tech space, is it fair to assume that a part of this was on account of your top account? And how is the growth and opportunity pool kind of shaping up for us in our top client?
Sure. So Mukul, top 5 has been kind of flattish, but the next 15 have done very well. So that's the first thing. The second point I'd like to make is that our largest clients, while as I've mentioned in the previous calls, right, suffered shrinkage of their own during the and pressures of their own during the pandemic. Their businesses have stabilized, and as their businesses have stabilized, the business we do with them has also stabilized. That's the second thing. The third thing is that within this group of accounts, within this group of top 5 accounts, there is always going to be a bit of an up or down going on between individual accounts. So there will be, of course, some quarters where all of them will fire and we'll see, good solid increase across board. But then across these 5 clients, there will be up or down. Some clients will go up, some clients will come down. And that is what we saw this quarter. 2-3 clients, 1 or 2 clients were flat, 1 or 2 clients went up, and 1 client came down, right? So which resulted into this flattish commentary for, flattish performance in the top 5 accounts. What is very encouraging for us, and like I mentioned, we are fiercely protective of that portfolio. We are fiercely focused on making sure we continue to deliver value to these clients and increase mind share and market share. What is also very encouraging for us is that the next set of 15 accounts and the following set of 35 accounts have grown. And that puts us in a good place to track momentum. The last quarter we had strong momentum. This quarter the momentum has increased, and we feel good about business right now. Mukul.
Sure. The other question was on N3BI. The Q2 revenues seemed a bit elevated if you compare them with what you guys reported for FY20 while acquiring them. Is there a seasonality in the numbers, or are you seeing a stronger than expected momentum in N3BI?
Short answer, stronger than expected momentum in N3BI. N3BI has been a very good acquisition for us, not just in the fact that it strengthens our capability in engineering and data, but overall the business is doing extremely well.
Great. And if I can just squeeze in a final question on your sales and marketing spend this quarter, is it possible to split out the impact of N3BI in this? How is the organic investment coming along, and where do you see that stabilizing?
Right. So I will start. I'll give you a point of view, and then I'll ask Navneet to chip in. So Mukul, as I mentioned, right, we continue to strengthen our team. Right, we did that in the first quarter of the year. We are continuing with that in the second quarter of the year. Be it sales, be it delivery, be it client partners, be it subject matter experts, and we are bringing in world-class talent, and we are very confident of the kind of people we've brought in. Right, big part of the team is in place. We will continue to hire some more, but the rate of hiring at that level is going to diminish a bit. This particular strata of leaders within the firm is now beginning to take shape, and we are nearing a completion of the phase where we said, okay, we're going to hire within the SGO, within the verticals, some within the geography. We are now coming to a point where most of this hiring is nearing conclusion. So that's my commentary on what's happening with hiring and sales, delivery, and client partner as well as subject matter expert roles. Navneet, would you like to add to it?
Yeah, sure, Ajay. So actually, Mukul, I think we've called out separately the top line of N3BI. But it's not that at a line item level we are disclosing the numbers separately. At the same time, yes, the consolidation brings in incremental costs in both cost of revenue as well as in SG&A. Directionally, I would say in the past, from a OPEX perspective, N3BI was not so invested into sales and marketing, and which is a rigor that we are putting as a part of what we are trying to drive through synergies and joint go-to-market. And to a certain extent, some investments we will be making will be to ensure that we are getting the right talent in place, and we are able to utilize the capabilities that they have to expand our offerings much further. So that's where we see we will be investing in. At the same time, directionally, I would say from a margin standpoint also, N3BI margins have been largely in line with what we have, and so there has not been any significant impact on account of inclusion of their numbers into our EBITDA. Is another point that I would want to clarify here, Mukul.
Sure, that's really helpful. Thanks for answering my question, and best of luck for the rest of the year.
Sure, thanks.
Thanks, Mukul.
Thank you. Ladies and gentlemen, in the interest of time and fairness to all participants, kindly restrict questions to 2 per participant. If you still have more questions, please join the queue afresh. We have a next question from the line of Sandeep Shah from Equirus Securities. Please go ahead.
Yeah, thanks for the opportunity. Just looking at second quarter, where the growth on organic front is upwards of 5%. Do you believe that now organic growth momentum can be maintained at least at the industry levels, or you still require some more time in terms of calling out the Q-on-Q sustainability of the organic growth? And also some color for the Q3, because generally in Q3 we have witnessed higher furloughs from some of our top accounts, whether this time it will repeat as a whole or not. And in the order book, how much TCV we have counted from the San Diego deal?
Right. So Sandeep, I will go first, and then I'd like to invite Manmeet to also chip in. So first of all, Sandeep, is that we had indicated. Let me just start with what started with the strategy refresh, right? So we had indicated that this strategy refresh in the last quarter had shown early signs of success, and that had given us confidence that we were heading in the right direction, right? So we saw momentum last quarter. The last quarter for us was the best organic quarter for us in the last 6 years. This quarter is even stronger than the last quarter, and this reinforces that confidence, and this has added to our momentum, right? So these two things, along with the fact that we are strongly in execution of the strategy. We have relaunched our brand, which has resonated extremely well with the market, with our clients, within the company, with our associates, including the fact that we have strengthened our go-to-market teams. The way we have crystallized our services, the way we are driving value proposition for our clients, we feel that we have been strengthening the franchise, and we feel that we believe that we have become significantly more competitive when compared to what's happening in the market. So that gives us confidence that we are on the right track, reinforces our momentum. So that's one part of the answer. The second part is, next quarter is a holiday quarter, so there is going to be some impact because of that, furloughs, etc. But overall, the momentum is good. Manmeet, do you want to add?
Yeah, sure. Ajay, see, like Ajay talked, Sandeep, I think the momentum that we are seeing from the deal side and how we are ramping up resources for the orders that we have, it's quite positive. At the same time, we know that the seasonality which happens is a phenomenon which has happened for us every year. So there will be some impact on account of that. And hence, anyways, we don't guide on our revenues, but you should assume that there will be some kind of an impact on account of furlough, while we will also continue to drive our volumes up. That's how we look at it from the immediate third quarter perspective. With respect to your second question in terms of the order book value, I think City of San Diego, as we had announced earlier, is a 4-year deal, along with 2 optional periods of 2 years each, where the maximum value that we had announced was about $122 million. Since we adopt a much more conservative approach in our order booking values that we disclose every quarter, we have just taken only the initial period of the order in our order book reporting. So in the 187.5 that we have reported, roughly 50% of this order value that we disclosed is contributed by the City deal. Sorry, let me just correct. When I said 50%, it was 50% of the 122 million is included largely as a part of this deal. Balance is deals which are outside of the large deals of the size.
Okay. And now just question on the margins, because there is a gross margin has slid significantly in this quarter. Even if you look at going forward with travel restrictions going, there would be increase in travel and facility related costs. So do you still stick to your high teens kind of an EBITDA margin outlook, or the outlook on margin has now changed, and what could be the range one can build for the near to medium term as a whole?
Yeah. So, as a management, we are clearly focused on hitting the margin outlook that we have been talking of, which is trying to ensure that we go from, say mid-teens to high-teens level. Having said that, the supply side constraints that we have seen have been very magnified, and that really puts some kind of challenge in terms of the time frame within which we'll be able to hit it. Of course, we are mindful of the fact that travel costs and facility costs will start coming back from the second half of this year. But we believe the operating leverage that we'll be able to generate on account of the momentum that we have built up should be able to negate the impact of such certain things. In terms of margins, I would say we are working in a very focused way on operating levers, which include how do we look at our pyramid, and there is a very high focus on getting significant amount of freshers in as a part of our talent. At the same time, we are also working on aggressive cost optimization measures, which will help us combat the impact on margins that we see. And of course, we are also working towards how do we improve our effective rate realizations. This could include a mix of trying to get some set of rate increases based on the value that we deliver to our customers, especially in high demand niche skills, as well as how we are able to optimize on our fixed price productivity. So those are the elements or the levers that we are working on, and we are confident that we should be able to hit the ranges that we have talked of. It's only that probably it will take some few more quarters to be able to hit that, and we are all working towards it. I would also ask Pramila to add further on from a perspective of operational efficiencies what we are actually doing as a company.
Yeah, thank you, Navneet. Sandeep, to just add to what Navneet called out, we have a very clear, focused and concerted program on all the operational levers, given the margin impact. So we are driving one of the three key call-outs. Ajay briefly mentioned this at the start. The whole pyramid optimization is a very comprehensive program for us. We are addressing it from different levels. One is significantly expanding the bottom of the pyramid. In fact, the fresher infusion is what we added in H1. We're going to add 5 times that number in H2 in terms of freshers. And an entire fresher program itself, we have really transformed it, moving away from the traditional just go to the campus, get some freshers, train them internally, to now we have expanded this to look at off-campus freshers. We've got a very strong partner ecosystem now, partners who take the freshers, train them, and then we onboard them in Zensar. We're looking at non-engineering talent stream. Also, our global fresher program. Fresher program is gone beyond India, so we have freshers in South Africa. We're going to add freshers in Europe and in US. We were doing small numbers. We will scale it up. So the whole fresher program itself is significantly expanded. The second thing is it is not just about onboarding freshers. Our focus is on how quickly do we get them to bill. So we have a very strong metric, what we call as time to billability. We are tracking that. For this, we are proactively investing significant amount of freshers in our high growth accounts, because we know that will be a big lever for us for fulfillment. The other thing we're doing is really enforcing pyramid guidelines as we're going and for new deals, both in existing client accounts and new client accounts, keeping the pyramid guideline as a lens as we staff our projects. So we start them with very fit and healthy pyramids. In fact, and the third one is about the cost optimization. What Navneet called out is looking at all our non-billing costs as we're adding freshers. Focus is on to quickly get them into billing roles. And then rate hike, like Navneet called out, we are looking both at the MSA level rate revisions for customers where predominantly we're doing work for them in the high-end skills and high-demand skills. We are also looking at the resource level. There are resources who now come in with a lot of multiple skills, and we are significantly investing in upskilling our organic talent, massive drives on certification in new age skills like cloud and digital full stack, data engineering and other areas. In each of these cases, we're also going back to conversations with our customers about rate revisions. But like Navneet called out, all of these will take a few quarters for us to really begin to deliver the impact. But we have a very senior vice president, Ajay called out, a P&L leader who's driving all of these tracks. So the entire focus is on rigorous execution of all of these tracks.
Okay. Thank you and all the best.
Thank you. Ladies and gentlemen, kindly restrict questions to per participant. We have next question from the line of Amit Chandra from HDFC Securities. Please go ahead.
Yes, good morning and thanks for the opportunity. Sir, my question is on the order book or the TCV value that you announced. So, as you have mentioned that we have taken 50% of San Diego, so X of that, the TCV number is still 130 million, which is still on a YOY basis, and if you see on a first half basis is still like lower than what we usually do. And so, are we seeing significant pickup there? So because we have said that we have a healthy pipeline, so when we can see an uptick there in terms of the TCV wins and what kind of engagements we are winning with the clients, and what is the steady state like TCV number that we are targeting? And also the second question is on the offshoring. So we have seen 80 basis increase in the offshoring in the quarter, but the San Diego deal, which is largely on site. So X of that, I would see that there had been would have been an increase in offshoring much higher than what we have reported. So, and how we are seeing the offshoring trend in the new engagements that we are doing.
Yeah. No, thanks, Amit. So Amit, let me go one question at a time. The first question is TCV, right? So if you look at the TCV that we announced for the quarter, and that includes City of San Diego, right? Which is we counted about 66, 67 odd $1 million. The first thing I would like to point out, and Navneet mentioned this just a little while back, is that overall we are taking a very conservative stance in terms of what we report as our order booking, much more so than we have done in the past, right? So very scrubbed, very clean number and a very conservative number, including how we are reporting, say, for example, City of San Diego. If you compare this number with last quarter, it has doubled. Even if you exclude City of San Diego, it went up about 60%. So this reflects increased momentum of business. So that's one. Second thing is that this quarter we have added 14 new logos. And this is in addition to 8 new logos that we closed last quarter. So while some of these give us immediate revenues, there is a bunch of others who basically create an opportunity for future expansion of business. So that is another thing that is firing really well. The third thing, which does not get reflected completely in the TCV, is our opportunity to expand within our existing accounts. So I mentioned we are in a very demand-rich environment, demand-rich supply constraint, right? A very demand-rich environment, and a part of that richness of demand, part of that amplification of demand, is our ability to expand within our existing clients, and that's not entirely reflected in the TCV. So we have 3 different metrics that we track in terms of looking at our ability to continue to drive momentum in the current quarter. So that's the answer to the first question. Amit, can you repeat the second question, please?
Yeah. So on the offshoring part, so already our offshoring number has been structurally the lowest in the industry, but we have seen the rise in the offshoring, right? And in this quarter there was a huge increase, but in this quarter we had San Diego, which is an on-site project. So X of that, the offshoring would have been much higher than what we have reported, and how we are seeing the offshoring trend in the neo wins that we are doing.
Yeah, no, it's a good point, right? So City of San Diego, the nature of the deal is such that it has to be delivered entirely from the local geography. it has to be delivered stateside. Despite that, our offshore ratio went up 80 basis points last quarter. That was the first, quick data point that I wanted to bring out. Despite that, our offshore ratio went up by 80 basis points last quarter. The next thing I'd like to point out is that we continue to focus on right shoring, and that includes continued thrust on driving up offshore presence. And I mentioned, right, in terms, when I was talking about talent acquisition and talent catchment, etc., is our strategy to expand outside of our 3 key locations into satellite centers. So that aside, we are also looking to increase our footprint near shore, right? So we are already present in Eastern Europe, we'll expand that. We're present in South America, we'll expand that. We're present, we will continue to expand our delivery out of Africa, right? And the way we are designing those are only for those projects where the cost of, the slightly higher cost of a nearshore location can be met by client's expectation to deliver out of a nearshore location. And we are watching over that, that commercial around nearshore very, very carefully. So it's a slightly more elaborate answer to your question, Amit, than you asked. But that is how we are. There's a very comprehensive view that we are taking towards right shoring.
Okay. Answer my last question on the margin side. So obviously we had an impact of around 500 basis on salary hike. So X of that, the steady state margin that we have earlier said, EBITDA margin would be in the range of 17 to 18%. So that is what we're targeting, or with these new contracts coming in, higher cost of delivery, we see that contracting to 15-16% level on a steady state.
Right. So the way we are looking at margins, Amit, is we are in a supply constrained market right now, and over the period of next 3 to 5 years, not only so we have our own very, very specific company-wide initiatives that Pramila so carefully elaborated a few minutes ago, right? Which we are driving, and over a period of time, as the industry focuses on getting the supply to fulfill the current big gap between demand and supply, that pressure will alleviate over the course of next 4 to 6 quarters. That's the first view we have, right? Second thing is that look, for the right skills, we are obviously very, very focused on making sure that the right skills command the right commercials. So that is number 2. Number 3 is, in terms of, how long will this play out, right? Which effort that we are making towards cranking up our organic engine, towards continued focus on right shoring, to expansion of delivery locations. So this will take 3 to 5 quarters, right? Now, the one thing which we are very clear about is that we will not take short-term knee-jerk measures. We are in a good place for growth, and that will continue to remain our top priority. And while we continue to drive our momentum, drive our growth, we will fix the overall supply situation and thereby fix the overall margin situation over the course of next 3 to 5 quarters. We are confident of delivering that.
Okay, sir. Thanks, and all the best for the future.
Thank you. We have next question from the line of Alroy Lobo from Kotak Investment Advisors. Please go ahead.
Yeah, thanks for taking my question. I just wanted you to comment on the cash flow profile of the company this quarter and the first half. It's come up quite significantly, when you look at year-on-year comparisons. I understand last year was a different year. But, how are you looking at cash flows while you focus on, getting the growth momentum back?
Yeah, Alroy, I request Navneet to answer that question.
Yeah. So if you were to see, I think over a period of time, the way we realize effective cash has improved very significantly for us. And from a net cash perspective, you will see this quarter was a slight aberration where our net cash has actually dipped from $183.4 million to about $160.8 million. That was largely on account of acquisition-related payout and like I called out, the annual variable pay which got paid out during this quarter. Our DSO continues to be consistent. While it is currently at 82 days, that 2 days increase is largely on account of the higher revenues coming in, because of which the debtors are higher, and the denominator is actually the LTM revenues. On a like-to-like basis, our DSOs would be at par with what it was in the previous quarter. And the cash flow generation that we have exhibited in FY21, we believe a similar momentum to continue for us, as we have really tightened our ship in terms of how we realize our money effectively and what use we are putting up to it. And as has been called out consistently, from a perspective of cash management, we continue to preserve cash so that we can fuel it for any potential acquisition that we are looking for, which is an integral part of our strategy, which we have consistently called out.
Mm-hmm. Because I was just looking at your first half number. This is before your acquisition. I'm looking at net cash flow from operating activities. That's quite meaningfully down from the first half of last year. And even if you were to even look at the last full year numbers for FY21, the cash flows for this half have been significantly down. This is I'm talking about before your acquisition. So this is from cash flow from operations.
Yeah. So the decline in cash flow for operations is on account of two reasons. Number one is, if you see, the debtors have gone up for us at this moment. And even as a component of a DSO, you will see that the billed DSO have gone up. And as we have billed much higher right now, the collections will fall in line in the second half. So that we will see a good improvement on that. Second thing is, like I called out, there is a significant reduction in liabilities that you will be seeing. And that is on account of the fact that the annual variable pay got paid out in the current quarter. So these are, I would say, not a very repeatable event which will impact in the coming next few quarters. And so we will see much more improved cash flow generation in the second half of the year, as opposed to what you have seen in first half. And the first half impact is largely on account of what you have seen happening in Q2. Apart from that, we see a healthy generation of cash at our end.
So there is no loosening of the terms of trade to get revenues. You're saying your terms of trade are more or less in the same band.
Yes, you're right.
Okay. Thank you.
Thank you. We have next question from the line of Nitin Padmanabhan from Investec. Please go ahead.
Yeah, hi. Thanks for the opportunity. I had a couple. So first is on how are you seeing subcontracting costs sort of increase for you? Not on the absolute terms that you report, but per resource, how would you have seen it maybe for the same kind of resource maybe 3 quarters back, and how is it now? On-site and offshore, if you could give some color there, maybe quantification not required. Second is in terms of freshers, how many freshers are you looking to have you added in the first half, and are you looking to add from a pyramid perspective? And lastly, in terms of do you think that the rise in attrition to maybe 23%, and maybe this is not going to cool off maybe at least for another 2 quarters, if that's the assumption, do you think that supply will actually start impacting your ability to sort of meet growth? So those are the questions. Thanks.
Yeah, Nitin, I'd like Namit to answer the first question. Start the second, and then Vivek to answer the rest of the second question, and I'll pick up the third question. So Namit, do you want to go ahead, please?
Yeah. So Nitin, as you said, this is a supply constrained market. So to that extent, yes, when we look at subcontracting particularly, the skills which are in demand, like you have resource in demand resulting in higher costs. Yes, in subcontracting also, the cost of hiring in specific areas have also gone up. And if you would see, to a certain extent, the subcontracting mix, cost mix also for Zensar has gone up as is evident for our financials, consequent to that. And all of this is anyways as a part of the operational measures that we are working on, and which I think Pramila already elaborated much more in details. With respect to fresher hiring, I think our perspective is to ensure that we have a very good steady intake of freshers every quarter, and which is how we have structured our hiring process on freshers. We normally do not disclose the hiring plans that we have, and hence I will not be able to share with you the exact quantum of freshers that we are looking to hire in the current year. But I would let Vivek add on qualitatively more with respect to the other 2 points which were related to fresher and the attrition part.
Thanks. Thanks a lot, Navneet. Navneet, you covered the point with respect to freshers very comprehensively, and Ajay also spoke about the retention measures very comprehensively. And these set of initiatives which we are talking about are the initiatives which will ensure that while industry is facing a serious headwind and attrition, we are very confident that the kind of initiatives we have undertaken and we are going to undertake, we will bring this in control.
Right. And thanks, Vivek, and thanks, Navneet. And Nitin, just to close out on your last question. So just once again, we are in a very demand-rich and supply-constrained environment. Is there a big gap between demand and supply? The answer to that is yes. Do we see that gap within the company between demand and supply? The answer to that is also yes. Are we focused on meeting as much of the demand as possible? The answer to that is also yes. Right? For us, growth remains a top priority. We will continue to be very strongly focused on growth while keeping a strong eye on margins. And we just want to make sure that our momentum of growth continues while we do root cause fix around attrition and around supply chain over the course of next 3 to 5 quarters.
Sure, that's helpful. Just one last one, if I may. Within your portfolio, if you look at the MSA price increases that you spoke about, do you think that you'll be able to reflect some of those sooner, or do you think it'll take some time to reflect on a consolidated basis? I just wanted your thoughts on that.
Yeah. Nitin, so that is going to be, ongoing. It's customer by customer, MSA by MSA, largely focused around the skills that are in high demand, the skills that are very inelastic. And that's an ongoing process that will continue, that, we're already on that journey, that will continue over the course of next.
Yeah, hi. Thank you for taking my question. I wanted to ask on the Smart City San Diego contract and taking cues on the pipeline from there, right? So, with regards to this contract, are there specialized capabilities that Zensar is building for smart cities, and how is this smart city and whole connected ecosystem space shaping up globally, and where does Zensar play in terms of where Zensar is placed in terms of winning more large deals in this space, and who are the competitors in this space?
Yeah, it's a good question. Not sure if we can answer all the questions that you asked, from smart city perspective, but can I request Harjot to address this question? He's right in the middle of our smart cities engagement and portfolio.
Sure. Thanks, Ajay. So the capabilities, we talked about were already existing within Zensar, which are largely around the digital transformation, laying the foundations for a smart and secure cities. So all those elements of digital experience management, digital operations driven by automation, digital cyber security, journey to cloud, managed private cloud, cloud economics. What we're doing is we are bringing all those elements together, combine that with IoT and smart sensors for very well-defined use cases for City of San Diego is what we are rolling out. So it's a huge transformation support and maintenance program. We see a pretty large market for this. There are a lot of post-COVID. There are a lot of cities, who are looking at becoming smart, digital, green cities. That's going to have a massive impact on their citizen experience, on their tax revenue, their ability to draw more business in. So we are engaged in those multiple conversations. So there's a lot of cadence and action we're seeing in this space, and we don't see the traditional competitors, the traditional India origin service providers having a very focused offering for smart cities. We believe Zensar is the pioneer in that space, where we have launched the reference architecture for smart cities, and we're implementing it very successfully. And a large part of this solution element is also system integration work with large tech OEMs, whether it's Honeywell, GE, Cisco, and public cloud providers as well. So a lot of elements to this solution. There's a lot of complexity around it, and we are in the middle of Zensar is kind of implementing that. So that's where we are. We see a large potential, as we, go through a successful implementation, and we continue to work with our OEM partners to roll out the future offerings as well. I hope that answers your question.
Yes, absolutely. That's very helpful. And just a related one. So in terms of energy, automotive, right, all of these coming into the new age, the technologies for the next decade, what the consumer will use for the next decade. Is there any bundling possible? For example, okay, we have smart cities, we are collecting data. At the same time, is Zensar looking to play in the automotive space as well and in the energy space as well? Let's say, a lot of the elements which are not covered in the smart city, particularly.
Yeah. So that's a great question. And this also goes back to the strategy question that Sandeep was asking. We have launched 4, offerings within high-tech manufacturing smart cities, basically which is aligned to how will these industries, how will the customers disrupt themselves to get ready to be successful in Industry 4.0. And those offerings are, all the elements which we discussed, plus IoT, edge, fog computing, and that's a combination we launch is more about supply chain 4.0, digital supply chain, connected operations, connected experience, and servitization. So these are the 4 large mega trends, we are seeing across multiple industries where they're using AI, data, machine learning, cloud to unlock the value, to, in their operations and create a very unique experience for the customers. So, the key vector of, business differentiation through experience, whether it's a citizen experience or with a consumer experience, remains central to everything we are delivering. And that's where our SEO story of end-to-end experience to engineering also comes in very handy.
Got it. Thank you so much. That's very helpful.
Thank you. Ladies and gentlemen, due to paucity of time, we'll take the last question. We have the last question from the line of Sandeep Shah from Equirus Securities. Please go ahead.
Yeah, just the question in terms of investment for the strategy refresh. Is it done and over in terms of the talent recruitment, in terms of the delivery optimization or restructuring as a whole? And one can say incrementally the operating leverage can play out more going forward versus what we have seen in last 2-3 quarters.
Sandeep, about April, we launched our new strategy, right? Revolves around 5 areas, 5 strategic growth areas, 21 frameworks, 4 pillars, which include the pillars being sales, talent, partnership, and M&A, right? So right now we are in a very strong execution phase. And as a part of that, as I mentioned just a little while back, we have strengthened our teams. And this strengthening has happened across sales, delivery, client partners, as well as subject matter experts, right? Now, this crystallized set of services, the strong value proposition we are driving through these services, and the significant thrust that we have on go-to-market is bearing fruit, right? And it has, like I said, it has strengthened our franchise, it has made us more competitive, right? And we are working towards this, to continuing this momentum that we have achieved in the last 2 quarters towards our goal of achieving predictable, sustainable, and profitable growth, right? And I think we are tracking well on our objectives. This quarter, obviously, cost of delivery has gone up. So, we created a very, very, like Pamela mentioned very elaborately, in terms of a very significant campaign to address that. And then that will pay out over the course of next 3 to 5 quarters. And then on this side, on the strategy side, on the momentum side, on the growth side, we will continue to strengthen the team. A big bulk of the recruitment that we wish to do is over. We will continue to add to our talent pool, especially when it comes to client partners, some salespeople in the vertical, etc. And I think we will come within what we have guided, which is, at the beginning of the year, I had mentioned that we'll take some money out of the EBITDA that we had at that point in time and reinvest back in growth. And over a period of time, we will deliver mid to high teens in margin. We will achieve that objective. We are confident of achieving that objective in the course of next 3 to 5 quarters.
Just a follow-up question. So, what is our go-to-market model? Is it vertical based with whom the 5 strategic SGOs will work, or it could be largely P&L handled through 5 strategic SGOs? If you can call out separately for US and Europe and South Africa.
Yeah. No, so Sandeep, we operate through 3 geographies, which is US, UK, and Europe and South Africa. 3 verticals, which is high-tech manufacturing that also includes emerging, banking, financial services, insurance, and consumer services, supported by 5 service lines, which are our SGOs, which is experience services, advanced engineering services, data engineering services, application services, including our play and platform services, and foundation services. So that is how we are structured. It's a play between geography, vertical, and service lines.
So we would be handling so many P&Ls within the company, or how the P&L across units would be handled or controlled?
Yeah, Sandeep, this is very commonplace in the industry. Having a geography, vertical, and horizontal view and the corresponding P&Ls is a very commonplace thing in our industry. It's not unique to us. What is unique to us is how we have sharpened the focus, how we have chosen these SGOs, and how we have sharpened the focus, and how we are executing on it. So from a P&L perspective, how we manage the numbers, etc., this is not, uncommon in our industry.
Okay. And just wanted to understand the San Diego deal would have ramped up only for 1.5 months in the quarter. So we'll have a full ramp up in the Q3 as well, right?
Navneet, you want to take that question?
Yeah. So we announced the deal during Q2, and yes, we had ramped up immediately after that. And your assessment on that is right. So it had partial revenues in the current quarter, and a full phase ramp up will happen in the next in Q3.
Okay. Thanks and all the best.
Thank you, sir.
Yes,
Ladies and
thank you.
gentlemen, that was the last question. I now like to hand the conference over to Mr. Ajay Bhutodia for closing comments. Over to you, sir.
Thank you. Thank you so much. It was great to interact with you. Thanks a lot for dialing in and listening into our earnings call. Look forward to engaging with you separately and look forward to talking to you soon. Thank you very much. Be healthy, be safe.
Thank you very much, sir. Ladies and gentlemen, on behalf of Motilal Oswal Financial Services, that concludes this conference call. Thank you for joining with us, and you may now disconnect your lines.